Hello and welcome everyone to session 4 of the institutional prop education. This is the English version, and today we'll be doing session 4, which is time frame correlation and market structure. Okay, so time frame correlation is extremely important. Okay, we need to understand how it is that our time frames work in the correct way. Okay, because a lot of people glance over time frames. You know, time frames are extremely important. They show you either more or less data, as explained in previous sessions. Okay, so what we want to do is we want to create a foundation around our strategy when it comes to time frame correlation. So time frame correlation basically involves seeing more or less data when it comes to our specific strategy. So once the strategy has been built up, okay, you'll be able to identify entry points, maybe just if you need a bit more data to, how can I say, validate the setup. Okay, that's when we'll be using timeframes to go either down or up to make sure that we are on the right track. So without any further ado, let's get started. So number one, time frame correlation. Okay, what we need to understand is if we're looking at a 4-hour time frame, okay, we have these two candles in front of us. It basically took 4 hours for these candles to open, form, and close. What I mean by form is after it opened, price moved up and down within the 4 hours, creating a high, creating a low, and then finally closing and creating a body of the candle. Okay, so same applies bullish and bearish. Okay, so when we use time frames, we actually now get to see more data. So within our 4-hour candle, if we go down in our time frames and we look at the 15-minute chart, okay, looking at the 15-minute chart, you will actually see that the market trended upwards within that 4 hours. Okay, so as price basically unfolded, there was actually a trend occurring. Okay, a bullish trend within that 4 hours on the 15-minute time frame. Very important to understand because, you know, instead of waiting for one 4-hour candle to close to basically get a signal or to validate a setup, you know, we can go down in our time frames. You can either intraday trade, you can trade within that session, you can trade scalp, you can scalp trade, you know, just by understanding how time frames work. Okay. So looking at this example over here that we have on the New Zealand dollar and the Canadian dollar, we can see on the right-hand side, excuse me, on the right-hand side, we have the current 4-hour candle developing. Okay, so you see there's a purple line over there, and that line basically represents the open of that 4-hour candle and where it is on this 15-minute time frame. So on the 15-minute time frame where you see the blue and the white candles, right? Where it starts over there, where it touches that candle, the white candle going down, that is where the 4-hour candle opened. Okay, so it opened, it formed by going down first and then up. Okay, and then there was still 11 minutes left on that 4-hour candle or that last 15-minute candle before the 4-hour candle completely closed. Okay, so as we can see within this 4-hour candle, that one green candle over there, price actually made a move down and then up, came down again, and then resumed going up. So there was actually a trend that occurred on the 15-minute time frame, all within that 4-hour candle. And as you can see over there, that is basically how price moved within that 4-hour candle, okay? If we're looking at a 4-hour bearish candle, the same applies, okay? As that 4-hour bearish candle open, forms, and closes, right? We then see on the 15-minute time frame that the market actually trended to the downside. There was actually a bearish trend occurring, okay, that formed that 4-hour candle. If we look at this example over here, we can see the purple line represents the open of that candle. Markets went up first and then came down, went slightly up and down again, and then started to pull back again, okay, to where that current candle was at that time, okay? And we can see that trend occurring on the 15-minute time frame. Price opened, pushed down, went up, created a high, went all the way down, created a low, and then was 4 minutes away from the body close of the 4-hour candle. But it actually trended on the 15-minute. Now, this is basically how it will look when there is bodies and wicks involved, okay? So you see how I marked out. Let's go back to this example. Oh no, we can stay here. You can see how I marked out that price went down first and then went up, okay? And even though that was a wick, that was price movement, okay? Now, likewise, in this scenario, when you see, let's say, for instance, these two bearish candles, that would be on the daily time frame, okay? Now, the wick on that second candle is actually a pullback on the daily time, on the 4-hour time frame, okay? So the pullback, so the wick that you see on the daily chart, okay, that wick on the second candle, that is actually a pullback on the 4-hour, okay? So if we have a look at this over here, we can basically see there we have our two daily candles. The first line over there, okay, you'll see it's marked out line 1 and line 2. Line 1 is basically where the first daily candle closed, right? And line 2 is where the second daily candle opened, okay? Now that wick that you see on the second daily candle, that wick is the pullback, that one candle pullback on the 4-hour time frame. And that is essentially what it looks like, okay? Now that pullback can be one candle, it can be 3 candles, it does not matter, okay? The fact that price pulled back, okay, into the previous candle, however much it did and in whichever time frame it did. So in this case, it did it in one 4-hour candle. It could have done it, it could have pulled all the way back up to the previous candle's open, all in that one candle, in that one 4-hour candle. It could have done that, okay? It doesn't have to be because it's so high that it only needs to pull back a small amount. No, it can pull back any amount. It depends on what price does within that period of time. Okay, so as we can see, the wick of that bullish candle on the 4-hour, okay, lines up with the wick of the daily, okay? So just for perspective, just so that you can understand that one candle was the wick for the daily. That one 4-hour bullish candle is what created the wick on the daily chart. That's it. That's all it is, okay? Now, if we're looking at multiple candles, okay, and we see a pattern within that, within those multiple candles. So in this case, we have a bullish variation. This I taught you, I think, in session 2, okay? We see a bullish variation or just a bullish engulfing, okay? So on the 1 hour, you would see that bullish variation. But on the 15-minute, you will actually see the entire setup being played out, okay? So you will see a lower high being broken, okay? So structure breaking on the 15-minute, creating a pullback and an extension, okay? This is showing us that our setup, even though the 1 hour only has 3 candles, on the 15-minute, the entire setup played out. So if we look at this over here, we can see that, okay, this is exactly what happened. We see, let me just come down here quickly so I can use my cursor. We can see that we had 1, 2, 3 candles, okay? But let's just take this bullish engulfing over here because this body is bigger than this body, so it engulfs it, okay? So just based off of that, there was a small liquidation over there, and then there was the break of structure over there, where a new candle open, formed, and closed above that lower high point over there. So we made a lower low, pullback, lower high, lower low, and then new structure high, breaking market structure over there. And that candle over there that open, formed, and closed above our break of structure line, okay, that was an indication that price is now going up. We had our pullback, okay, into a specific area of which we will learn in later sessions, and price started to move from there. So you can see just based off of this 1 hour pattern over here, we basically had an entire setup play out over there. Okay, so let's look at the next one. Where am I? Oh, yeah. Okay, so if that was not enough data on the 15-minute, even though it played out perfectly, we can go down a time frame to see more data, okay? And the more data we see, the more we can make a judgment or a speculation on what price is going to be doing. So in this case, we had, again, liquidation, market structure shift. You will learn about liquidation in future sessions, okay? We had the market structure shift, and then we had a nice return, okay, into a point of interest over there, and then price basically moving from that. So you see how we use time frames to basically play out our setup, okay? So I showed you market structure and the basics or the foundation of market structure in the previous session, okay? So this is just taking that now to the next level of understanding, okay? So let's dive into some more market structure techniques, basically, or let's just go deeper into market structure. So if we look at advanced market structure, we can basically see, if we start off from the beginning, an uptrend consists of higher highs and higher lows. In order for price to go higher, it needs to break a previous high, okay? And in order for price to stay bullish, all the higher lows need to remain intact and not broken, okay? This, if I may ask, make a quick assumption over here. Do you think that this is a break of structure? Okay, because I said higher lows need to remain intact, right? But there is one exception when it comes to this, okay? So if you can just, I'll give you a few seconds, actually, not 2 minutes, a few seconds. Try and answer this quickly. Do you think that this structure is now broken? That's fully bullish. Do you think that this is a broken structure? If your answer was no, you are correct. If your answer was yes, I will explain and correct what you thought was a break of structure. Okay, so this is not a break of structure, and I'll explain to you why that is now. Okay, firstly, we have an impulse leg. Okay, so each and every time price makes a new high, okay, every time we make a new high, okay, that leg that created the new high is now the new impulse. Okay, it is an impulse, and an impulse consists of all bullish candles. Okay, this is an impulse to the upside. All bullish candles going up. There will be an exception of one if it has a long wick and price does not create a new candle below that long wick of that bearish candle within that impulse. I'll show you examples later on, but that is the one exception. Okay, there can be one candle in the opposite direction as long as price does not break and close below the wick of that candle. It will still be an impulse. Okay, so an impulse is basically a strong move to the upside, okay, without creating any bearish candles, but with the exception of one, if price does not close below it, okay, then it still remains an impulse. Anything that happens between the low and the high of that impulse is a pullback. Anything that happens between the high and the low of the impulse, the one that created a new high, okay, a higher high, right? Anything in between those two is a pullback. That's an impulse, that's a pullback right there, okay? So in this scenario over here, we basically had price create a new high, okay? And this was a strong bullish move to the upside with no interruption of bearish candles over there. So all the way up, anything between the low and the high of an impulse, a validated impulse, this is the pullback, okay? Anything between it is the pullback, right? So let's have a look at this example over here. Right here, we can see that we are in a continuation bullish move to the upside, okay? And right there, we have our impulse leg. We have a pullback, but price does not create a new high yet, okay? So while it is still between the low and the high, price can do whatever it wants until we create a new high and a new candle open, forms, and closes above that line. Okay, so all of this was a pullback, and then price continued again. Okay, let's have a look at this. So impulse, pullback, or retracement. That is basically what we see after an impulse. Okay, just so that we know, this is not a break of structure. Okay, not a break of structure. Only once we break below the low of our impulse, only then it becomes a break of structure. Okay, like this. That's when it is a break of structure, not like this. I hope that makes sense. Our impulse leg, that's not a break of structure. That is a break of structure. Okay, so what we will then wait for after that break of structure is basically a nice pullback into a point of interest, and obviously wait for a nice signal over there on that specific time frame or any time frame lower, okay? And then we can basically get involved in the shorts because we now understand that the structure has broken from bullish to bearish. Here's a nice example of that. We have basically our impulse over there. We have the high, we have the low. This was our last bearish candle over there. So once price breaks below, okay, and open, forms, and closes with a new candle, okay, below the break of structure line, then it is a break of structure. Why? Because we are below our impulse, okay? And anything that happens in between our impulse is a pullback until price breaks, okay? So what do we have then? A nice pullback into a point of interest. In this case, our point of interest was this area of support and resistance. Here we had resistance in this area. That resistance turned into support, okay? Then price then came, broke out over there, broke structure, created a new low, and then on the pullback, we would basically find our entry on a lower time frame than the 4-hour, okay? Because this is our point of interest, right? So let's look at a downtrend scenario, because it just helps to see from a bullish perspective and a bearish perspective, okay? So in a bullish scenario, we basically have price making lower highs and lower lows. Each of the moves creating a new low is the impulse. So an impulse only occurs, I hope you're writing this down, once price creates a new low, okay? Breaking past a previous low creates a new low. We look at the high of that impulse leg and the low of that impulse leg. And anything that happens in between the high and the low, that is considered a pullback or a retracement, okay? Let's go on. If we look at the break scenario, this is not a break. Why? Because we are still contained within the high and the low of our impulse, okay? That is just a pullback and obviously, or a retracement from the impulse. So impulse, high, low, okay? The only way for price to break market structure is if that impulse gets broken, okay? This is just a continuation trade. If we look at this scenario over here, we basically had price already in a downward move, right? So we already had bearish pressure. We had our impulse, and then we had our pullback. Now our pullback went all the way and touched into our impulse high, but we did not open, form, and close a new candle above. Okay, remember what I said. We have to open, form, and close a new candle above. That validates the break of structure or the market structure shift. They are the same thing, okay? So in this scenario over here, once price broke below with this candle, the next one open, formed, and closed below the break of structure line. And that over there, that was our validation that price is now broken, okay? So we're always looking for the one candle, okay? So in this case, this was our pivot from up, down, right here, down, up, okay? That bearish candle is our signal that this is the end of the line for the bullish structure. Likewise in this scenario, okay? If we break above this, because it is our impulse, okay, and there's a bullish candle behind it, if price breaks above, open, forms, and closes a new candle above, then that would then change the structure. It changes the entire dynamic of the structure, this bearish structure. Okay, so that is what a valid market structure break looks like once we have violated the high of our impulse leg. I hope this is making sense for you guys. If anybody has any questions, please do let me know. I hope you guys are following along with this. So let's look at a few examples over here. If we look to the left over here, we can see we had a nice strong impulse to the downside, okay? Strong impulse, right? And then over there, price went all the way back up. Not yet, but only here, only in this area over here. Let me try and zoom in. Right there, okay? So that candle broke out. It actually happened before. Let's go back. Let's have a look. Okay, so it was mainly, okay, so this was a tricky one because if we look over here, we had this big candle, but it was overshadowing our previous areas over there. So you can take from the bullish, but it's not good to cut through the line, the wicks, okay? But in certain situations, as long as your eye can basically see what is happening, then you can do that, okay? But in this scenario, I would go with that high over there of this candle as it basically engulfs these two candles over here. So their prices are behind what happened here. So this one basically made a much higher high and a much lower low. So we can go with that one over there. I think that's why I drew that box from there, okay? So if we look at that from the start of this bullish candle, this rectangle over there, okay? This candle broke out, okay? That one broke out and came back inside. This one broke out and a new candle open, formed, and closed above, okay? Open, formed, and closed above the beginning of this rectangle over here. So just with that over there, we can see that price has now shifted to the upside, okay? We are now in bullish territory. It took a very long time to get there, but it eventually happened. And once it happened, okay, price came all the way back. And this was a point of interest. Why? Because we had resistance, okay? And that resistance then turned into support, supporting price to push higher, okay? That is a nice example over there of this structure. Now, here's what we're going to do. So we need rules. We need a set of rules when it comes to catching the perfect reversal. Okay, so identifying the structure and all of that stuff. So in an up to down reversal, okay, so that's bullish to bearish reversal, we must first see price create a new high, then break structure afterwards. What do I mean by that? Let's have a look at an example, okay? In this case over here, we had price first create a new high, okay? So we had a previous high, okay? We created a new high, meaning that this move here, let's just take that move. That move, okay, was our last impulse. And then price broke that impulse, okay? So choppy, 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 and that was our move to the upside. You can take this, but to be safe, we will go with this one over here, okay? So we had this previous impulse, okay? Price went up, made a nice pullback, and from here, we created a new impulse, okay? We first took out that previous high. Now you are going to understand later on why price would need to take out that previous high. We are going to talk about liquidation. We are going to talk about smart money. We are going to talk about manipulation. And, you know, if you don't know that these things exist within the markets, then that would be something extremely beneficial for you. Or if you don't know how to identify or to trade based off of manipulation, well, not entirely based off of it, but at least use it to your advantage, because a lot of people are just getting manipulated and they are not banking from that, okay? So understanding why manipulation happens, all of that stuff is going to be covered. So do make sure that you return for those next sessions, okay? Because I'm going to be laying it all down, all of it. I'm going to teach you everything I know, okay? So price first took out a high, then broke structure. Now, I left this out so that I can show you afterwards. If we look at this impulse over here, we had that impulse first, then we had a pullback, okay? Now, if we look at this, we had a drop, small pullback, but then what happened? Price then went below that previous impulse low, okay? Then went up, okay, to break structure. Can you see that? So we first liquidated, okay? You're going to learn about this stuff, but it's literally happening all the time, everywhere, okay? So same like this one, we had the high, then we had price first make a new high, then break structure, okay? Let's go to another example. We had a high here, first price made a new high, then broke structure, okay? So we want to see that last structure high being put in. And that is literally just going to tell us that anybody that was basically selling, I don't want to give the future sessions away or anything, but just so that you understand, you know, just to grab guys that have been selling off early or selling previously in previous price back there, you know, their stop losses first go and get taken, okay? You will understand why in later sessions, okay? So in an up to down reversal, we first see price create a new high, then break structure afterwards. And this is for catching the perfect reversal, okay? There's the scenario. Now, that was a bullish scenario. This is a bearish scenario. In a bearish scenario, we see there's an impulse, price pulls back, creates a new impulse, and then breaks structure, okay? So we must first see a previous impulse basically get raided and then go to break structure. I hope you guys are seeing what I'm trying to show you over here. So in a bullish scenario, we wait for price to create a new high. In a bearish scenario, we wait for price to create a new low first, then break structure. Now, this is just going to solidify the strategy. It makes the strategy so much more stronger when price first makes a new low or first makes a new high, then break structure. Why? Because it's telling us that anybody that was entering trades over here and placing their stop loss below here get taken out as liquidity, and then price shifts direction. Then the direction changes, okay? Why? Because there is now liquidity in the market, okay? Hope that makes sense, right? So, number two, break of structure is valid, right? A break of structure is valid when we have a candle open, form, and close above or below the break of structure line, just like I showed you guys before. A new candle must open, form, and close below the break of structure line or above the break of structure line, like in this scenario over here. So from bearish to bullish, okay, price must go and break past the break of structure line and open, form, and close, a new candle above the break of structure line. That is a valid break of structure. And then what you wait for is price to pull down into an area of interest, right? A point of interest somewhere in here as the pullback for you to get into a trade to continue buying. Likewise over here, we wait for a break. We got our break, but now we need a new candle to open, form, and close to validate that this is now a real break of structure. Okay. Once we have that information, we are counting the impulse and then the pullback. Then we sell, okay, at a point of interest. In this case, support turned resistance. We will find more examples within here if we go down in time frame, okay? Then we can find more entries over there. Okay, so number 3. Enter your trade when you see a support or resistance level or candle signal like the engulfing candles, okay? So just like I explained right now over here, you will wait for price to pull back to a point of interest. It can be support and resistance. It can be anything else that I'm going to teach you later on. There is more than just support and resistance. But once you get up to that area of interest, you will then wait for price to show you a candlestick signal that says sell. In this case, bearish engulfing right there. At the previous support, now new resistance, there's a bearish engulfing. Good opportunity to sell. Okay. In this case over here, we had the variation. Okay. So liquidation, break of structure, price pulls back to a previous support. Okay. That support comes, finds support again. We broke through the first time, broke through the second time, and now we find support. And then we have 1, 2, 3 candles to the upside. That is our bullish variation. However, it is on the 4-hour. This is a sketchy trade to do on the 4-hour unless you have a very big account, like a funded account. Okay, stop loss below there, buy it up. That's it. Okay, and that is the end of our session 4. I hope you guys enjoyed that. I hope you learned a lot. I will stick around for a few minutes. If you have any questions, do let me know in the chat. Hope you guys enjoyed that one. I will see you on the next one. Cheers.